Greetings, everyone. I am Elif Ture.
And I'm Bryn Battersby.
The Covid-19 crisis has devastated our lives, jobs, and businesses. Many lives have been lost. Unemployment and bankruptcies have soared to historical highs. Millions of people have fallen into extreme poverty, reversing a decades-long declining trend. And income inequality is set to rise significantly. Yet, these outcomes would have been much worse without the lifeline measures governments have taken. But how large has the government support been in each country? What type of support have governments provided? Who are the main beneficiaries of government support? There is growing concern that government support might be benefiting large corporate firms instead of vulnerable people and small businesses most in need. With global public debt projected to reach 100% of GDP this year, its highest level in recorded history, the size and the scope of government support provided today will shape and constrain fiscal policy for decades to come. And with limited room but significant need for further government support, the benefits and the recipients need to be identified, and the costs and the risks need to be assessed carefully. Well, to be able to do so, we created a new database that tracks government support to people and firms during the COVID-19 crisis in 180 countries. And here is what the data tell us. First, the global fiscal response to the COVID-19 crisis has been unprecedented, totaling a staggering $12 trillion, much higher than the response to the global financial crisis a decade ago. Half of this response has been additional government spending and temporary tax cuts to boost health systems or to support livelihoods, for instance, through expanded cash transfers or unemployment benefits. And the other half has been liquidity support, particularly to firms, for instance, loans, guarantees, or equity injections by the public sector. Second, these global aggregates mask heterogeneity. The size and the type of fiscal response has varied widely by country. In this chart, we show the breakdown of global fiscal support by income group, country income group, and by type of beneficiary, by type of measure. In terms of size, we see that in advanced economies, where the pandemic hit earlier and harder and financing conditions are favorable, the response has been forceful. But in many emerging markets, and especially low-income countries, however, the response has been limited, mainly due to financing and capacity constraints. In terms of type, we see that liquidity support, that's the blue bar, has been higher among advanced economies, whereas additional spending and tax cuts, that's the red bars, have been higher for emerging markets and low-income countries. Third, collectively, firms have been the main recipients of government support, particularly among the large advanced economies. In this chart, we show the share of fiscal support in the G20 advanced and emerging market economies by beneficiary. We see that loans and guarantees in particular, that's the light bars, have been commonly used by G20 countries to support firms, including the small ones. These loans and guarantees have had many benefits. For instance, they've helped cash-strapped businesses to cover their operating costs, such as the wages of their employees. They've also ensured proper functioning of financial markets, because banks may not be willing or able to lend in these uncertain times, at least without government guarantees. In fact, in the euro area, banks reported that government guarantees have been essential for them to keep credit standards favorable for small businesses. But what about the costs of these measures? It's important to note that different measures have different implications for government budgets and fiscal balances. The additional government spending and tax cuts, they typically take place within government budgets. Therefore, they immediately raise lower fiscal balances. But liquidity support, such as loans and guarantees, are different. They usually have very low upfront costs for governments. In fact, loans are just assets for governments because they create future cash flows. And guarantees are simply promises to cover loan losses. These low upfront costs, along with important benefits, make these measures appealing. But, as Bryn will highlight, these measures also present risks and challenges for governments that need to be managed carefully.
Thanks, Elif. So, liquidity measures like loans and guarantees do need to be carefully assessed and managed for two main reasons. They create new risks for government and they can be challenging to implement. And I'm going to dig into these two reasons in a little bit more detail. So, loans and guarantees create new fiscal risks, and these can often remain unknown or poorly understood long after they've been implemented. Loans might not be repaid, government guarantees might be called, and these would create costs for government down the road. That's why it's important that governments carefully assess and disclose both the maximum exposure of these measures and their expected costs. Governments should test whether these costs can be accommodated in a worst-case scenario, and they should design risk mitigation strategies, like setting aside fiscal buffers to cover any expected losses. But assessing and managing these risks can be challenging, especially for countries that are embarking on these measures for the first time. You know, their exceptional nature, their large size, and the speed with which they've been deployed all mean that it's imperative that governments track and disclose and carefully manage these measures and the risks. As you may have heard us say, you know, governments should do whatever it takes to address the emergency, but they should keep the receipts. The second main reason that countries should carefully consider these measures is that they can be tricky to implement. Now, on the one hand, governments are looking to ensure that vulnerable firms are able to access the support they need without having to deal with overburdening conditionality. And on the other hand, governments also want to make sure that support is not being diverted to firms that don't actually need it. And finding this balance can be, and I think has been, tricky. Preliminary data give us some indication of the challenges that some countries have been having here. This chart shows the announced guarantee commitments of the 5 largest European economies and the take-up of those guarantees to date. And what it shows is that only about a quarter of the announced guarantees in these 5 countries have been so far actually taken up. Now, this might pick up as we move from the emergency through to the recovery. Moreover, just the existence of these very large loan and guarantee programs is important because it can help to boost market confidence and that can support economic activity. But we also know that in some cases, the rules and restrictions have made it difficult for some firms, especially small businesses, to access these loans and guarantees. In other cases, the loan sizes might have been too large or the guarantee coverage too low for the targeted firms. Still, these experiences are helping countries to better design or better target these packages. For example, in the United Kingdom, the number of small business loans was 20 times higher under a newer scheme than an earlier scheme. And that was partly because the newer scheme better targeted these firms with smaller loan sizes and higher government guarantees. And that's a good example of why it's important to continuously review these measures and to revise them when necessary. At each stage, policymakers should be thinking about the benefits and the costs and the risks of these measures. And they should keep in mind that design really matters. The right rules and incentives can help to ensure the right firms are able to access the support they need. And governments should have in place a process for unwinding these exceptional measures and for reducing risks as conditions improve. And this is what we want to leave you with. The careful design, review and management of these measures is really crucial. Poor design and execution could be very costly, and it could constrain budgets and fiscal policy for many years to come. But well-designed, transparent and well-managed measures can target the right firms, can minimise the ultimate cost for taxpayers, and can support a more durable and quicker recovery. Thank you.
Thank you.